Hi, Carolyn Larsen-Wieber here, and this is my video series titled Coronavirus and Market Volatility. It's a four-part series, and you're looking at part two. In part two, we're going to take some market jargon and define it, and then we're going to find some perspective by looking at our market's history over time. So let's get started. So during this pandemic, a lot of my clients and people I meet, my friends, are tuned into the news, and especially the market news. So it's good to start with some definitions here. So what's a correction in the market? It's when the market moves 10% or more down. So I like to think of it like it's more like an airplane. An airplane is going to its destination and it's maybe gotten off course by 10%. It just has to correct itself to get back on going to its destination. So then we turn to what is a bear market. A bear market is 20% or more down for 2 or more months. But there really isn't an industry standard. If you Google bear market, you're going to get probably 3 or 4 or 5 different definitions. You'll always see the 20%, but it's always different when it's 2 months or longer. What is a recession? A recession is kind of tied to the market, but it's more of an economic downturn. And the indicators that you look at are things like GDP, which is gross domestic product, and unemployment, and those indicators, and potentially the market is also down in a recession. So if you're losing sleep over the volatility driven by the cascade of disheartening news, it may help to remember that the stock market is historically cyclical. And you'll see in the slide, in a few slides further here, that there's been this cycle ever since 1926. But in the last 20 years, since 1980, there's been 20 corrections, 9 bear markets, and 5 recessions. So let's face it, if you've got your ear to the news, looking daily at what's going on with the market, take for example today. Today, while recording this video, this morning I opened up my market app and the Wall Street Journal had headlines: market dive according to tensions with the United States and China. And by the time I ended my video today, now the Wall Street Journal says stocks rise slightly despite renewed US-China tensions. And that's just today. So it's hard to find perspective when we're looking at the daily moves in the market up and down. That's why I like this chart that I have here. This chart comes from Vanguard. And what Vanguard did is they modeled a $1,000 investment, and they used the biggest financial crisis that we had, which was 2007 to 2008. And so if you were an investor and you had $1,000 before the financial crisis and you had it all in cash, by the end of the longest running bull market in history, which was 11 years, that $1,000 would be translated into $951. Now, if you had that same $1,000 in the market before the financial crisis and it was in 100% bonds, at the end of the 11 years, it would be approximately $1,300. But if you had a portfolio that was 60% stock and 40% bond, that $1,000, mind you, you had to ride it all the way down and not get out of the market. At the end of the 11 years, that $1,000 would be approximately $2,200. So what I try to do for my clients is definitely give them some perspective about the long term. And what we do is I help them design a portfolio that is tied to their financial goals and to their risk tolerance. And then I talk to them about the cyclical nature of the market. And now, mind you, in this example, this is just one 10 years worth of history. Most of my clients are going to be in the market in retirement for 20, 30, 40 years. And you just have to understand that the markets are cyclical. And, this is just a normal course of action. And that taking the long-term approach is the best way and is the best defense. So as you listen to the daily market news, you most likely hear something like, oh, the S&P 500 index, it's down 200 points, or the S&P 500 index is up 200 points. I mean, what does that even mean? Does everybody just remember what the number was yesterday so they can compare it with today? No, and it's not even helpful at all. The only thing it does is it creates fear for us, fear of the uncertainty, and it sells news, it sells TV news, it sells articles in the Wall Street Journal, and so on. It's definitely not helpful. So what I like to do is give my clients, myself, and my friends perspective on the market. So you'll never see this slide in any news program. What it is, it's the S&P 500 index over history from 1926 to 2019. And just take a look at it. Look at all the bull markets and all the rates of returns that we've had compared to the bear markets. Do you remember 1973? That was tough. I mean, you see in pictures when you go back and look at it. I mean, people had to wait hours in line to get gas, and you can only get gas if you had an even number on your license plate. You could only get gas certain days of the week. But look at what happened after 1973. Look at the market and the rates of returns. Then we move on to 2001. That was the dot-com bubble, and I believe that the bear market lasted 24 months. But then after that, you were rewarded up until 2007, 2008, when we had the financial crisis. Those were tough times. That was a huge financial crisis. But then what was it followed by? It was followed by the longest bull run on record. And here we are now. Now we're in another bear market, and it's the coronavirus. But in perspective, if you concentrate on listening to the daily news and being affected by it, it isn't helpful. Now, over history, there's been opportunities in both the down and the up markets. But this is what I want you to think about now. Well, the S&P 500 is either up or down. The question is to ask yourself is what portion of my portfolio is in the stock market? For example, if you have a 50-50 mix of stocks versus bonds, and the S&P 500 index is down 20%, that'll more or less translate into your portfolio not being down 20%, more like 10%. Remember, bonds and fixed income portion of your portfolio, that's going to create stability. But the stock portion is going to provide you, as we can see, the long-term reward for the risk that you're willing to take. I help you and my clients determine what mix is right for you, dependent on your long-term goals. And what we use is we use something called an investment policy statement, and we create that for you, and that's our roadmap that we follow. And it's there in your file, and we pull it out in times like this when our emotions get to us. So what's our takeaway from this video? Well, the first thing I want you to think about is, what can you control? You can't control the market, and you can't control the coronavirus, but what you can control are your expenses. And I don't know about you, but what I've been doing in quarantine is really thinking about all of those line items on my expense sheet where I used to spend money, and I think about it now, I'm like, some of those things I really don't need. And maybe you're thinking the same thing. Also, asset allocation, that is absolutely your best defense. It's the portion of your portfolio that's stocks versus bonds. And that's what you need to focus on long term. And remember, as we look at those slides and we look at the S&P 500 over history, there is a reward for patience, and that reward is in the recovery time. And finally, if you haven't really gotten it, how many times I've said it, tune out the noise. It's short term. It sells TV. Turn it off and think about the perspective in this video, and you'll be fine. So, after you've listened to this video, what should you do next? Well, if you're a client of mine, please call me with any questions that you have. I would love to help you with that. Second, take and share this video with your friends and your family. And remember, friends get a 30-minute consult complimentary. Hi, friends and family. There's 2 ways to register to receive my weekly videos. First, you can take that first URL and put it in your browser. It'll take you directly to my registration page. Alternatively, you can go to my website, Larsen-Wieber, and click on the Web Events tab and register there. And finally, if you'd like a 30-minute consultation free, email me at carolyn@clwfinancialplanning.com. I hope you enjoyed this video, and please look for my 3rd part in the 4-part series. Thank you for listening.